Hello and welcome back to your South King County real estate update. My name is Sarah Eggleston with Stone Egg Realty at John L. Scott, and I am back to deliver your South King County real estate news for the week. Go ahead and jump on into these slides. Today is June 17th, 2022, and let's find out what happened this week. I have my summer buyer and seller guides now available, so if you're considering making a move this year, please reach out. I would love to provide these resources to you. It's tons of great information about today's market and what you need to know about buying or selling in today's market. So make sure to reach out for your copy. And what happened this week? So this week was a little frustrating for me. There's more inventory on the market. I keep hearing about price reductions and listings that are sitting on the market and not going pending the first weekend. But we put an offer in for my higher end luxury clients at around the 2 million price point. And we came in third of 5 offers. This is still, the interest rates rising is certainly not affecting everyone. If people are moving forward with cash, interest rates don't affect them. So there was a lot of people that are shopping below their price point anyway. So those people can afford to bid up if they need to. So the luxury market, the competition is still really strong. There's some other homes in kind of the same general price range in that area on the market that are sitting, but the best priced homes are still flying off the market with multiple offers. So we are still hunting for these clients, and hopefully we can lock something in soon. Okay, I'll go ahead and get jumped back into these slides. So Western Washington's housing market, more balanced, not so crazy, and that's a good thing. This is the statistical press release for Northwest MLS for the May stats. Sellers need to rethink their expectations. There's a lot, as I said before, there's a lot of price reductions. People have been listing their homes for several months now and getting way over the list price. So when they see that their neighbor's home sold for 117% of list price, they think their home should sell for 117% of list price too, which is understandable, but yesterday's market is not today's market. So there was a report that was released that showed a significant increase in active listings compared to a year ago. This broker was out of Tacoma, but they said multiple offers and waived inspections, at least in Pierce County, are behind us. So people are getting our offers accepted with more inspection contingencies, possibly a home sale contingency, like they have to sell their other home. There's a lot of opportunities right now in this market for buyers who have been struggling to compete over the past several months. So don't drop out now. There's a lot of opportunity out there. We were up 9.7% from a year earlier on the number of new listings in the inventory. And we were up 59% from a year ago on active listings in May for the overall MLS area. This is the chief economist at Windermere. He's saying that with the significant increase of homes for sale, there's a lot of people that think that the market might implode, but that is absolutely not what is happening. Our buyer demand is still really strong, and we've got shifting towards a more balanced market, which we have been in a very strong seller's market for years and years. So this is a welcome relief to some buyers who have been wanting to purchase a home and have been struggling to compete. Pending sales is down 11.7% from a year ago, but up 8.2% from April. And J. Lennox Scott, chairman and CEO at John L. Scott, said unsold inventory is ticking upwards locally as more new listings hit the market. This gives buyers an increased selection of desirable properties to choose from as they hunt for their new home. Though there is still a steady backlog of buyers in the market, the increase in inventory means each home will receive fewer offers and may not go pending the first weekend. Seasonal home price flattening is also in play, which means premium pricing is off for most properties. In the spring, when there's fewer homes on the market, we get premium pricing. This is something that happens in our general cycle year to year. We get more homes on the market throughout the summer. Demand is spread out amongst more homes, and the premium pricing is not in play as much anymore. So we were at 105% of asking price this past month, which in April, it was 107.7. And March, it was 108.2%. So we can see this, we are on this downward trend on what people are getting based on their list price. Scott also noted luxury sales activity has held steady due to strong buyer demand in the Puget Sound area. So this is what I was just talking about. There's certain pockets of the market that are not cooling down quite yet. And he says that there's just a huge backlog of buyers with a great economy. We have a lot of really high paying jobs in our area. So those people are still able to really compete at the high end. Fed attacks inflation with its largest rate hike since 1994. On Wednesday, the Fed raised the interest rate 0.75. This is the biggest jump since 1994 in a single swoop. Inflation rose last month at a rate of 8.6, and that is a 4-decade high. So the Fed is really just trying to slow down this runaway inflation and took strong action. This is a quote from the Fed chair, Jerome Powell. "We thought strong action was warranted at this meeting, and we delivered that." And they certainly did. The goal for inflation is 2%, and we're at 8.6. So there's a ways to go to correct that. He also said that we should be expecting more of these raises in the future. Inflation is just running too hot, and they need to calm it down. I'm going to get into this a little bit more in depth in a second, but the Fed on Wednesday acknowledged that it is struggling to curb the pace of inflation. And there's been a lot of things that have played into that. The pandemic, gas prices, energy prices, and the whole Russian invasion of Ukraine has really affected inflation. So they're expecting at least 2 more rate hikes by the end of 2023 to get inflation to about 3%. But it is going to take a lot longer than they initially thought, and a lot more aggressive action than they had thought a couple months ago. And the forecast is that growth will be about 1.7 this year and next for the economy. So how is this higher Fed rate going to affect your finances? Well, we know that those record low mortgage rates are gone. There's other borrowing costs that will likely rise in the future. Combined with the other rate hikes that we have seen this year, this is the fastest rate hike increase since 1989. Everything will be more expensive. So if you're buying a car, homes, anything else where you're borrowing money, it will be more expensive. The risks are really high. There's a lot of economists that are not forecasting a recession quite yet, but the risks are incredibly high. And everyone's aware that the risks are increasingly growing, and we really need to tread lightly to avoid a recession. So once we start seeing unemployment, rising layoffs, and continued pressure on stocks, this is signs that we are headed towards a recession. I'm considering buying a house. Will mortgage rates keep going up? Rates on homes have soared in the past couple months and probably will continue to do so, at least in the short term. The Fed doesn't control the mortgage rates. They control the Fed rate, which banks lend to each other at. But the 10-year Treasury note is a much better indicator of mortgage rates, and there's a variety of factors influencing that. For now, the faster inflation and strong U.S. economic growth are sending the 10-year Treasury rate up sharply, so we are seeing those mortgage rates go up quite sharply as well. Will it still be tough to find a house? We kind of touched on this a little bit. We are getting more inventory on the market, so there's going to be fewer multiple offers on houses and homes sitting on the market a little bit longer. It will be tough to find a house, but it will get increasingly easier as some people drop out of the market because of the rising interest rates and just more inventory. So this article talks about just how high is the risk of another recession. Economists are divided whether they think there's a recession coming or not. If so, when, how intense will it be? But for now, economists generally believe it won't happen in the super near future, but we are starting to see possible signs of a recession happening in the future. As of right now, our job market is still going along really strong. And we have some of the lowest unemployment in decades. People are still buying, consuming. So our economy is still plugging along. But with rising interest rates, that borrowing cost higher, people tend to spend less. And if they spend a lot less, companies will make less money and have to do layoffs. That's what leads us into a recession. How would the Fed's rate hikes weaken the economy? Home sales have fallen in a response to these higher borrowing rates, and that is a really important industry. We're seeing fewer trends for the more expensive borrowing options like houses. And we expect to see that in other markets like cars and other things you might use a credit card for. How is spending affected? Borrowing costs for businesses are rising. So if business costs are rising, they have to raise prices. People can afford to buy fewer things. So it's basically this whole intertwined ball of spending and employment. Does a sinking stock market hurt the economy? The sinking stock market will affect certain households, but usually those households are not the ones that are, on the verge of being able to afford mortgage or food or those things. People that generally invest in the stock market, that is excess income that they are investing. Falling share prices also tend to diminish the ability of corporations to expand, fewer jobs, this cycle continues. So what are the signs of an impending recession? The clearest signal that a recession might be nearing, economists say, would be a steady rise in job losses and a surge in unemployment. As a rule of thumb, an increase in the unemployment rate of 0.3 percentage point on average over the previous 3 months has meant that a recession will eventually follow. Other things to watch out for is an inverted yield curve. There's the 10-year Treasury and the short-term Treasury, the 3-month. So when the costs of the borrowing for 3-month and 10-year invert, we know that there is a recession coming. However, it can take 18 to 24 months for that recession to actually arrive. And we did briefly have that inversion this past week. So this is definitely something to keep an eye out for. But history proves that a recession does not equal a housing crisis. So even though we're talking about a recession, we are not talking about a housing crisis. In fact, during 4 of the 6 last recessions, home prices actually increased. The first time that it didn't was 1991, and home prices only decreased by about 2%. And the second time was 2008, when housing caused the recession, and we are very much not in the same setup anymore. If you have any questions about that, reach out. I would love to have a conversation with you about that. We are seeing a slight decrease in showings around North America. And we did see in our market stat minute for King County that we had fewer new listings and fewer pendings this past week. If we bring it to our little local breakouts here, we can see that in Renton, Auburn, and Kent, we do have more new listings than pendings. Federal Way, that is not the case. There are more pendings than new listings, so their inventory might be a little tight in Federal Way if you're looking to purchase a home in that area. Last week, our weekly average mortgage rate was 5.23, and this week we are at 5.78. So this is our weekly average rate. Remember, this is a Monday to Monday comparison, but if we bring it to today, we are at 6.03, which is actually down from yesterday. If we look back at Tuesday was 6.28. So it has been an incredibly volatile week with a lot of upward action, but we are seeing a little bit of relief at the 6.03 from where we were on Tuesday at 6.28. And just remember that for each percentage point an interest rate goes up, a buyer loses about 10 to 12% of their purchasing power. So here they have 2 examples of houses. The top one is the sold price was $765,000. Bottom one was $694,000. It's about the same monthly payment, $4,100 a month. And if the rates go from 5 to 6%, this is the difference in purchasing power that you have. Instead of being able to purchase this new construction, you'll be purchasing something that's built in 1990 for this example. But home prices do go up over time. So even if home prices do happen to depreciate, which no one is is predicting. Over time, things will go up. So if you're not trying to flip and make a quick turn of it, homes are a long-term investment and they will always rise in the long term. And if you would like that summer buyer or seller guide for 2022, reach out, let me know. I do have those available. And if you have any questions, please feel free to reach out. I'd love to have a conversation with you about the real estate market in your area or an area you may be interested in moving to. Let's just set up a time and chat. My phone number and email address are on the screen there. And thank you so much for joining me. I will be back here next Friday at 3 p.m. with your local South King County real estate news for real estate, mortgage news, and anything relevant to our housing market. So I will see you next week. Have a good one.